Welcome to my channel. World Scene News. Subscribe to my channel for news updates all around the world. In the early hours of a December morning, as the world's financial centers slowly flickered to life, global markets were rocked by an event that would send shockwaves through every major economy. The usual calm of pre-market hours was shattered, not by a natural disaster, not by a cyber attack, but by a financial shockwave that no one saw coming. Screens across trading floors from London to New York lit up with red, as stock charts plunged and traders scrambled to make sense of the chaos. Financial news tickers flashed urgent headlines, and the world's attention snapped to the source of the disruption. The Bank of Japan, long considered a steady hand in global finance, had just executed a move that stunned the world, selling $22 billion worth of U.S. Treasury bonds in a single calculated transaction. This was not a gradual divestment, but a bold, deliberate act, one that would reverberate far beyond Tokyo's financial district. For decades, Japan has been a pillar of support for U.S. debt, quietly purchasing treasuries and reinforcing the stability of the global financial system. This sudden massive sale marked a dramatic break from tradition, a signal that the old rules might no longer apply. In Washington, the news hit with the force of a bombshell. There were no warnings, no subtle hints in diplomatic backchannels, just a seismic shift that left policymakers and financial leaders reeling. The White House scrambled to convene emergency meetings as officials tried to assess the potential fallout. Analysts and economists around the globe scrambled for answers. Was this a calculated financial strategy to protect Japan's own economy, or was it a geopolitical message aimed at Washington? Theories abounded, but facts were scarce, and the uncertainty only fueled the market's anxiety. The silence from Tokyo was deafening. No official statements, no press conferences, just closed doors and unanswered questions. In the corridors of U.S. power, the lack of communication from Japan only deepened the unease, leaving leaders to wonder what might come next. This was more than a simple transaction. It was a challenge to the unwritten rules that have governed global finance for generations. The move threatened to upend the delicate balance of trust and cooperation that underpins the world's economic system. The timing could not have been more critical. It was late 2025, and the world was still struggling to recover from the economic scars of the pandemic. Markets were fragile, confidence was shaky, and any disruption risked tipping the balance toward renewed crisis. As the world's media converged on Washington and Tokyo, the globe held its breath, waiting for the next move. Would the U.S. respond with reassurance, or would this spark a new era of financial uncertainty? The world now watched, waiting for Washington's response. To understand the shock that rippled through global markets, let's break down what government bonds actually are, and why they matter so much to the world economy. At their core, a government bond is simply a loan. When a government needs to raise money, maybe to build roads, fund schools, or pay for national defense, it borrows from investors by issuing bonds. Investors hand over their money, and in return, the government promises to pay it back on a set date, with regular interest payments along the way. U.S. Treasury bonds, in particular, are considered the gold standard of safety in the financial world. They're backed by the full faith and credit of the United States government, which has a long history of always paying its debts on time. That reputation makes these bonds incredibly attractive to investors everywhere, from individuals to massive institutions. Countries like Japan, which often have extra U.S. dollars from trade, buy these bonds as a way to safely invest their money. This creates a cycle. The U.S. gets the funds it needs while countries like Japan earn steady interest and keep their reserves secure. It's a relationship built on trust and mutual benefit, and it helps keep the global financial system stable. But what happens if a major holder, like Japan, suddenly decides to sell a huge chunk of its U.S. bonds? When a large amount of bonds hits the market at once, it's like a flood. Prices drop quickly, and interest rates shoot up as the government has to offer better returns to attract new buyers. Higher interest rates mean it becomes much more expensive for the U.S. government to borrow money in the future. This can put serious strain on the federal budget, forcing tough choices about spending and debt. So, when Japan made the decision to sell, it wasn't just a routine trade. It sent shockwaves through financial markets, grabbing the attention of investors and policymakers worldwide. If other countries or big investors see this and start selling too, it could trigger a domino effect. the US would face a chain reaction of rising borrowing costs, which could ripple out to affect everything from mortgage rates to global economic growth. That's why the actions of big bondholders, whether they're foreign governments, central banks, or giant investment funds, are watched so closely. Their decisions can move markets, influence interest rates, and even impact the financial health of entire countries. In the end, the power to shape US finances, and by extension the global economy, often lies in the hands of these influential bondholders. Their choices can determine the cost of borrowing, the strength of the dollar, and the stability of markets worldwide. The US and Japan's financial relationship has been a cornerstone of global stability for decades. This partnership has not only influenced the economic landscapes of both nations, but has also played a crucial role in shaping global financial markets. Japan's export-driven economy generated huge dollar reserves, which it invested in US treasuries. This investment strategy provided Japan with a stable and secure place to park its vast reserves. This kept US interest rates low, making borrowing cheaper for everyone, from governments to families. Lower interest rates spurred economic growth by encouraging spending and investment. In return, Japan enjoyed a safe place for its savings, ensuring financial security for its citizens and investors, and supported its biggest customer, the American consumer. Japanese products became household staples in the US, from electronics to automobiles. This cycle fueled growth on both sides of the Pacific. The interdependence created a robust economic engine that benefited both nations, but Japan's sudden sales signals a possible end to this comfortable arrangement. The financial markets are now grappling with the implications of this move. Is this a one-time move, or the start of a bigger shift away from US debt? Analysts are debating the potential long-term impacts. The prospect of unwinding this deep relationship has markets and policymakers on edge. The uncertainty is causing ripples across global financial systems. The stakes couldn't be higher for both nations. The future of this financial symbiosis will shape the economic trajectories of the US and Japan for years to come. In Washington, Japan's move triggered emergency meetings and urgent questions. The fear: if Japan is losing faith in US debt, will others follow? The Trump administration, proud of its America First stance, suddenly faced a test of its economic strength. Lawmakers demanded answers. What's the risk? What's the plan? The event exposed a vulnerability: America's reliance on foreign creditors. Beyond markets, the worry was strategic. Could this financial rift spill into security and diplomacy? The bond sale wasn't just about money, it was about power and trust. Washington was forced to confront its dependence on allies in a new, uncomfortable way. Multi-billion-dollar bond sales might seem distant, but their impact is personal. US Treasury yields set the benchmark for everything from mortgages to car loans. If yields rise, so do borrowing costs for families and businesses. A homebuyer faces higher payments. A small business owner pays more for a loan. Higher rates can slow investment, hiring, and even raise prices at the grocery store. Corporations pass on their increased costs to consumers. A financial tremor in Tokyo can ripple all the way to your local market. In a global economy, no one is insulated from these decisions. The effects are real, and they're felt on Main Street. From Tokyo's perspective, selling US bonds was a strategic necessity. Japan's leaders worried about having too many eggs in the US dollar basket. With an aging population and rising domestic costs, diversification became urgent. US treasuries, once safe, now offered poor returns, sometimes even losses after inflation. The sale was a logical step to seek better investments and reduce risk. Politically, Japan was uneasy with America's unpredictable policies and protectionist rhetoric. Reducing exposure to US debt was a prudent hedge. The message: Japan will act in its own interests, even if it unsettles allies. This was financial independence, not confrontation. The move was carefully calibrated to protect Japan's future without burning bridges. After the sale, both governments scrambled to contain the fallout. Emergency calls between US and Japanese officials aimed to clarify intentions and calm nerves. Japan framed the move as economic prudence, not hostility, and reaffirmed its commitment to the alliance. The US Federal Reserve stood ready to stabilize markets if needed. The Treasury explored ways to attract new buyers for its debt. Both sides worked to keep the financial shock from becoming a diplomatic crisis. For the US, the event was a wake-up call to reduce reliance on foreign financing. Quiet diplomacy and tough policy choices now lie ahead. The aftershock forced both nations to rethink their strategies. For President Trump, Japan's move was a political and economic dilemma. America first called for independence, but the US still needed foreign capital. A tough response risked spooking markets and making things worse. The administration had to balance strength at home with reassurance abroad. Public statements required careful calibration, projecting resilience without triggering panic. Personal politics complicated matters, as Trump's style clashed with the need for quiet diplomacy. The administration was caught between nationalist instincts and global realities. The path forward would shape not just markets, but America's global standing. Japan's bold move has changed the global financial game. The big question, is this the start of a broader shift away from US debt? If others follow, America could face higher borrowing costs and a weaker dollar. The US must now confront its dependence on foreign capital and rethink its fiscal path. A more multipolar financial world may emerge, with new risks and opportunities. The transition could be volatile, as markets adjust to new realities. The world will watch how Washington and Tokyo manage this turning point. This is about more than bonds, it's about shifting global power. The US-Japan partnership, once rock solid, now faces real strain. The future of global finance hangs in the balance.